presentation contains current opinions of Moe Sansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone and welcome to the Compact Market Wrap YouTube update for February 18th, 2025. It's a holiday shortened week, but new all-time highs today in the S&P 500. I'm going to talk about it. Always love saying that whenever the market makes new all-time highs. Hopefully your portfolio is also doing the same. Let's go and take a look. First of all, I want to remind all of you to click on the subscribe channel so whenever I post an update, you'll be notified and you can come and watch the charts and all of the things that I talk about absolutely free today. Let's look at the market. Last week we were up 1.52% for the S&P. The Dow was up 0.65%, but up number one was the NASDAQ. It was one, S&P was number two, and the Dow was number three. That is the configuration I like. And we're breaking out to the upside. Seems like we've gone sideways for a couple of months, built a nice space, got some of the froth out of the market. People are worried, oh my God, taxes could go up. We've got a trade war going on. All of those things combined. So that could be what people are worried about. So we'll have to wait and see how this plays out. But I like the way the markets are starting to form. Best sector last week, technology up 3.8%. For the year, communication services, which is really Google and Meta, they're up 8.9%. That is the best sector. But the S&P is up 4.1% for the year already. 2 months into the year, a month and a half into the year, we're up 4%. Nice return so far. It's going to be choppy, and that's what we've seen so far. And I'm going to talk about the charts a little bit later on. Oil was down a little bit, but it's come back up. Today was a big day. Gold is pushing nearly 3,000. It had a big update. It was a big down day on Friday, big update today, just going back and forth, up and down. Interest rates did a flip-flop last week. They went up a lot, interest rates did, when the CPI came out hotter than expected. But then we had the PPI, the producer price index, come in lower than expected, and that brought the rates back down. At the end of the day, at the end of the week, we ended down slightly, 2 basis points for the interest rates from 4.9 to 4.7. As long as we're here, 4 to 4.5, going back and forth, I think the market can handle that. One of the big things that everybody was worried about over the last couple of years is office buildings, how that would collapse and that could create some problems for the regional banks. We did see some problems, but you can see that the absorption rate, the amount of square feet being used for commercial real estate is now, again, getting positive. We're down big during COVID. We're also down to 23 and 24, but now we're starting to see it start getting positive where more people are going back into the office. That could create more activity around busy office space and all the businesses around offices. That could definitely be a positive for all of that and could be also a positive for the real estate, the office market. But I think the housing market, as far as the real estate and housing, single-family homes, I think we could see some pullback there, which could be good overall as far as the inflation number is concerned. Looking at last week, we had CPI come in hotter than expected. Two of the biggest components there were shelter, which is really rents, and we saw auto insurance. I looked at some auto insurance numbers today. Insurance companies are lowering auto insurance rates in a number of areas, which is, I think, going to feed into the CPI in the next few months. As far as housing is concerned, more houses are starting to come to market, and people have come to the realization 6.5% is the mortgage you have to learn to live with. The 3.5%, 4% mortgages are gone. So with that, I think people are saying, okay, maybe I'll sell. It's a good price to get out here and downsize. Some of the baby boomers, the people who are starting families, are looking to buy newer homes, saying, look, maybe I can buy now. And if rates do come down, I can refinance. So I think with that, we should see shelter, which is a much slower, takes a long time for rents to come down or rents to stabilize. But I think they've stabilized and they're not going up. We are going to get housing starts this week. It's expected to be a big jump to around 1.397 or maybe 1.4 million units. That's what we need, about 1.4 to 1.5 just to have enough replacement there. Also, we're going to see existing home sales, and they're expected to be up, so we'll have to wait and see how they come out. Looking at the technicals, the market's sort of going sideways since the beginning of December. We've been here, 6,100, 61 and a quarter, and about 5,800 on the downside, just going back and forth, up and down, up and down. Now we're back up. If we can break out decisively above here, then my target is around 62, 62.50, which I've talked about right around here, is what I'm looking. That's the projection we get from the Fibonacci third wave high. Weeklies, as long as we stay above the 20-week moving average, which I've talked about since October of 2023, when we broke to the downside, broke above it, this red line, and we've stayed above it, came back here, tested it. That was a buying opportunity. Came back here, broke below it, but then if it's green, that means it closed back above the 20-week moving average. Again, July of last year was another opportunity. Came down here, broke below it, came right back above close. And 2 weeks ago, we tested it right here. So as long as we're here, the trend is your friend. It's on the upside. If you break below the 20-week moving average, this red line, then I think we're starting a fourth wave pullback on the weeklies, which could take us to 56.22 is where we are. But I think it'll be around 57, 5,800. That's the same low that we made in December, and somewhere around October, November, December is what I'm talking about. So that low could be tested. But if you come back from 6,300 back down to 5,800, that's about a 7-8% pullback, just about a normal pullback in the market. Looking at the NASDAQ, again, sideways market right here. We've been going back and forth for about 3 months now. We can break out above 20,000. That would be positive on the upside. The downside number is 18.3. That's my dot plot. As long as the dots are below these lines, vertical lines of the market, as long as the trend is your friend. So that's the dot plot that I look at. Once we get below it, 6, 7, 8 weeks at least to the downside, just like we were here, downside. But once the dot plot gets positive and the market is above these dots right here, that's all positive to the upside that I'm looking at. 10-year yield, I think 4.5 right here to about 4% on the downside, or 4.5 is where we are, just going back and forth, up and down. As long as we're there, I think until we see inflation coming down, we don't see interest rates coming down dramatically. Small caps 227, 20-week moving average. We need to break out above 245. That will be the breakout on the weeklies. Again, that's small caps have gone up, come down, but the trend still looks okay. As long as we're there, I think we're okay, but nothing very exciting there. One of the markets that was exciting, and this was a surprising, I talked about this on the podcast with Javed, and Javed brought this up. He said, do you think what is the best market of the year? And I said, well, he said, well, it's Germany. It's up 16%. They've been in recession for 2 years in a row. Why is Germany going up? Is their economy going to take off? Well, there's talk that there's going to be new government coming in Germany that might take off the debt brake, as it's called, where they can do some more deficit spending. That could stimulate their economy a lot more, and there's talk about that. So we'll have to wait and see. But we're starting to see China is even up 6.8% so far. The U.S. is up 4.1% according to the S&P. So I think something to watch. Maybe these international markets are going to, because they're just so undervalued, not that their profits are going to soar or whatever, but they're just so undervalued relative to the United States. So that's something to keep an eye on in the long term. Crude oil came back down from that $80 mark, which I had talked about quite a bit, that I was looking at. So that $80 mark is still right around here, came all the way down to about 70. Now we're about 72, 71, $72, just back and forth. Gold has had a big run up to about the 3,000 mark. We tested that, 29.50, back and forth, up and down. Today was a big day, up about $50 a barrel, or $50 an ounce for the gold market. So overall, gold looks good. But that's the old gold. The new gold, the Bitcoin hasn't done anything for the last 2-3 months. We saw the big surge after the election, but now we've gone sideways. So it's gone through a digestion process. The new gold, as the younger people want to buy Bitcoin rather than gold, it hasn't done much of anything one way or the other. Those are my thoughts. Again, if you need help with your portfolios, don't forget to send us an email at invest@compact.com. We'll do a free analysis of your portfolio. We'll give you some ideas, what you should do, what you should not do with your portfolio, or just call us the old-fashioned way. Pick up the phone, 800-388-9700. Make sure you subscribe to this channel. Click on the subscribe button so you can get this update every time I post a new update, and you can watch it at yours. Those are my thoughts. Those are my observations. So this week, I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compac Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.